Hello, everybody. Welcome to VRIC Media, your most trusted voice in metals and mining. We are bringing the VRIC to you each and every week with our series of expert online panels. We've got another great one lined up for you today. We've got Chris Vermeulen, founder of the Technical Traders, and Jesse Felder, the founder and publisher of the Felder Report. Gentlemen, it is great to bring you together for this panel.
Great to talk with you too. I'm really looking forward to this. It'll be a lot of fun.
Yeah, thanks for having me, Jesse. Pleasure.
Well, let's kick things off with getting both of your takes on where we stand right now when it comes to the global economy and how the Trump administration's policies are having an impact on international trade. It should be noted that the day that we're recording this is Monday, May the 12th, and it seems like the Trump administration and China have come to some sort of agreement in terms of reducing the overall tariffs from both sides, at least for a temporary 90-day pause. However, this does still create a lot of uncertainty because there's been a lot of back and forth. Now we're going to do this, now we're going to do that coming from the Trump administration. And I would imagine that that uncertainty will have an impact. I wonder what both of your thoughts are. Jesse, I'll start with you.
Yeah, I think we're it's very clear from the first quarter GDP report and a bunch of other, soft data that we've seen in the last few months that we're close to, if not already in recession. You see a lot of businesses putting those sorts of CapEx plans on hold. You hear a lot about consumers doing the same. A lot of the earnings reports we've heard about first quarter consumer-focused companies talking about, whether it was Chipotle or McDonald's, a variety of names talking about weakness in consumer spending and consumers acting in a much more conservative way. So I think it's very clear that economic growth is slowing. We had the negative GDP print in the first quarter. A lot of that was inventory building, which kind of skewed the numbers, but at the same time, we're seeing inflation figures climb, and median CPI really only fell to about 3.5%, from its peak a few years ago. So the fact that and looks to be turning higher. So at the same time, you have growth slowing, inflation higher. There's a lot of evidence pointing to a stagflationary outcome, which is really not good for consumer sentiment. So I think there's, it's clear that the economy's teetering right now, and we could have already, recession could have already begun. The way they date these things, they probably won't tell us until 6 to 9 months after the recession already began. So yeah, I think stagflation is kind of the kind of the default outcome right now.
And Chris, your thoughts? Would you concur that a recession is likely up ahead, or perhaps we're already in one? And how do you feel like the Trump administration's tariff policies here are going to impact the global economy and markets moving forward?
Yeah, I think Jesse pretty much nailed it. I'm in line with what he's talking about. There's no doubt tariff, I think, is going to create almost like a mini COVID in terms of a little bit of extra, I think, inflation. We've seen, you look at the LA port, the amount of containers that are, I think they're talking about 54 containers less a week coming into just that one port alone. They're saying United States has got 7 weeks worth of inventory of typical products. And there's like nothing coming from China. So there's going to be this several month period where things are going to just start disappearing. They're not going to be restocked. We're going to fall into this mini COVID feeling where it's like, oh, we're running out of, products, and people could start to put the pricing up again and gouge and create a little bit of inflation and big demand, no supply. So it's definitely creating wrinkles in the universe. I think what's happening today is we're seeing stocks rally. I've been talking to a lot of investors, and many that I work with are entrepreneurs who bring products over from China. And they were saying, they've got container loads there that they didn't want to bring over because the tariffs just make it so they can't even make any money with double and more so the price. But now, obviously, everyone's probably calling the China factories right now. I used to run an importing company and had products made there years ago. So I totally understand the pressures going on. And so today, the China phones are probably ringing at the factory saying, send those containers right now before the tariffs kick in, get our product over here. And as Jesse mentioned earlier, I think the first, quarter of the year of all this talk tariff created all kinds of people to just start buying, doubling up on their orders to get product here so they can keep some good profit margins. So the numbers are all fudged in terms of where do we stand. I believe we're already in a recession. Things are slowing. The real estate side of the market is the bottom's about to drop out, which is going to hurt investors a lot. I mean, when the stock market falls and then they feel the real estate starts to go down, that's when investors really start to panic because their two biggest asset classes will be dropping. So there's a lot of things to unpack and unfold, but I believe we're starting or already in a recession, depending on how you want to gauge it going forward.
Well, let's talk about the broad market, specifically the big indices, the S&P, the Nasdaq, the Dow Jones. I speak to some people who see a massive correction coming, a potential bear market on the horizon. I've spoken to others like Chris Whalen who are long the S&P and the indices and see continued growth up ahead. I'm wondering where both of you stand at the moment because you're both kind of talking about recession, either potentially already being in one or one up ahead. And yet we are seeing stocks rally, as you mentioned, Chris, on news of this China deal. It seems right now that the market is very fixated on the tariff policies and is looking for any sliver of hope to cause participants to once again buy into these broad indices, which many people believe are overvalued. I wonder where you both stand on the current health of the broad market. And Jesse, I'll go to you first.
Yeah, I am bearish. I was actually doing a ton of trading before we started this morning, selling a lot of the things that I bought on a trading basis over the last, number of weeks. One of the main things, that I look at to gauge, the valuation of the stock market and the trend of the stock market is insider trading activity. This is something that I've tracked for my entire career. And in aggregate, when you look at the total amount of insider buying to insider selling, it's actually one of the best leading indicators of stock prices and economic activity 18 months to 2 years in the future. And so last year we saw a huge spike in insider selling. In fact, in the first half of the year, it was just off the charts. But it took that 12-month ratio, which is really the one you want to watch, the 12-month look back period, way over 20 times the amount of dollars sold to bought. And that's typically a very good leading indicator of an earnings recession and bear market. We saw that back in 2021, insider selling was off the chart. 22, we had that bear market. We didn't get the recession side of it. But so that's one thing I'm watching very closely right now. And insider buying has really not picked up in any meaningful way at all. So in the middle of actually early 2022, during that bear market, we saw insiders step in and start buying pretty heavily, in the first really third of that bear market. And they bought heavily during the entire year. We haven't even seen that kind of early, buying. Insiders are always early, famously. And so that sustained buying for about 6 months by insiders in 2022 was a good sign that the economy wasn't going to go into recession and that we were going to see a rebound in 23, 24, which we did. So the fact that we're not seeing any insider buying to speak of so far is to me a really clear sign that valuations have not come down to levels that are attractive yet. And the insiders aren't seeing the light at the end of the tunnel in their businesses yet to get positive about a potential turnaround. And so that's one thing that I'm watching closely. I want to see insiders start to get bullish and maintain a bullish posture for a couple of quarters, probably, before I can get excited about buying stocks again.
And Chris, your thoughts on the current health of the broad market and whether you see continued upside or potential correction and perhaps even a bear market up ahead?
Yeah, sure. I'll share my charts and I'll share kind of what I'm kind of seeing in the market. So if we start on the zoom in on a really short-term chart, as Jesse just kind of mentioned, this morning was chaos. We were closing some positions this morning with this massive gap up. This is the S&P 500, huge gap up this morning on the news. We've got this FOMO indicator, which from a short-term standpoint, whenever we get FOMO, it usually means we're going to see some type of pullback, which I believe we're going to see. When we have panic selling, we tend to see it becoming a buying opportunity in the market. So short term, the markets are flopping between panic and then FOMO. And today is a day of FOMO. There's good news, and everybody's just driving the markets up and thinking the markets are going to go higher. But when we look at what Jesse was saying, I believe we're kind of entering more of a bear market phase. Now, this is the weekly chart of the S&P 500. And the key thing here is to identify from technical analysis when we're in a bullish environment, when we are in a bearish environment in 2022. And of course, we were in a bullish environment just until recently, and now we're back into a bearish environment. And I believe this is a dead cat bounce. This is a bear market rally, something similar to over here. And I think this is good news. This is good news. People are piling into, and they're getting overconfident. And I believe this market will stall out. And I think we're going to go into a much bigger sell-off in the market. And we're in a stage three phase, which is something that I like to follow. And there's four stages to the market. And a stage three is a very difficult stage. The market has been in this for a little while. And we're about to go into a stage four, which is a financial reset. It's not just a bear market like 2022. That was really just a pullback and correction. A stage four is like a financial reset, like the 2008, the tech bubble. We're going to see, I think, a global economic turndown, and there's going to be blood on the streets. There's going to be a ton of selling and assets falling. And what's really interesting is over the past month or so, there's this chart here that shows how much money's been piling into the leveraged long ETFs. And people keep saying everybody's buying the dip, buy the dip. There's so many new traders and investors that haven't been through a financial crisis yet. They think every dip should be bought. And they can until the one that breaks your back or breaks your bank account number. And I believe we're coming to one of those bank breaking kind of corrections. And so everybody's been piling in to the long ETFs, betting on higher pricing. And what's really cool, Jesse, is I've overlaid two charts here. The top one is the S&P 500 monthly chart, the 2008 market top and the bear market. The bottom one is where we are right now. Well, last month is similar to the month we saw in 2008, the first big crack to the downside in the S&P 500, where we kicked over into like bearish territory. And this blue spike on both of these charts is people searching the term bear market. And so I believe the tide has really changed. And it's interesting because a lot of people are giving me feedback saying, hey, listen, well, if everybody's betting on or knows we're going into a bear market, it's not going to happen. And that's not the case. Just because people know something, these are massive global tides. This is a global cycle that's going to happen. And it's not going to, just because people know about it, doesn't mean it's going to come to an end. And I always like the analogy of the ocean. Just because we know the tide's going to go down at noon today, doesn't mean it's not going to go down because we know. And that's what these massive waves and cycles in the stock market are going to go through. So, couple this with what Jesse was sharing with insider trading and all that stuff. There's so many things that are telling us that this is like a bear market rally, a bounce. The market is great at hurting the majority of people, and the motion today, the excitement is going to suck people into this market and literally probably buy up near the highs again, and then watch the bottom drop out over the next 6, 8, 12 months, however long a bear market or financial reset takes this time.
Yeah, that's interesting. I've also heard some people point out an opinion that if everybody knows a bear market is going to happen, it's not going to happen. I don't think that's exactly how it works. Jesse, I'm wondering what your thoughts are on what Chris laid out there in terms of a really serious market correction. Do you think we could see an outright crash into a bear market in the broad market? In that situation, how long do you think we could either go down or sideways here? Could we see a situation like with the Nikkei in Japan over that decade-long span of time, the lost decade? I've spoken to some people who think we could see a 5 to 10 year bear market. What are your thoughts?
Yeah, I really appreciate Chris's perspective. I think I would just point out too that Robert Shiller wrote a book on how, not just irrational exuberance, which is kind of the book he's famous for. He wrote another one about narratives and how narratives drive markets. And in the case of that type of people searching bear market, you need that narrative to actually grow in order to get a bear market, right? And so the fact that people are talking about a bear market is the driving, the necessary driving factor that you need to actually get one. So, I think it's dangerous to try and look at that from a contrarian perspective. I'll just, share my screen here and show some of these charts that I'm looking at. Let's see. Yeah. So these are the This is the insider sell to buy ratio that I was mentioning a minute ago. The red line there in the bottom of the chart is the 12-month, and then the yellow line, if you can see that, is the 13-week sell to buy ratio. So you can see during this 22 bear market, the 13-week ratio fell below 10 pretty quickly early in 2022, and that was insiders starting to get bullish. Right now, we're just back over 20 again in terms of the 13-week ratio. So we haven't even seen insiders start to get bullish yet. When I flip over to this EPS chart, you can see this red line on the chart is once again, it's that insider sell to buy ratio turned upside down and advanced 20 months. So 20 months in the future, insiders are telling you where earnings are going to go, right? And so right now, this big surge in insider selling we've seen over the last year suggests that an earnings recession is ahead. And if it's commensurate with the things we've seen in the past, S&P 500 earnings could fall easily 20% over the next a few quarters, potentially by the end of the year is kind of what this suggests. Right now, analysts are expecting that, earnings are going to actually rise by double digits. So the fact that insiders are saying, no, it's going to be much worse than that, I think suggests that the stock prices have a lot of, repricing to do, given the fact that earnings are very likely to disappoint. So I think that probably means we break down to new lows. And, we're already trading at a pretty high valuation on those forward earnings, which are probably wrong. So if you get a decreasing multiple, right, a lower multiple on lower earnings, you're probably talking about a pretty significant decline.
Let's talk about gold for a moment here. One of the few assets that held up very well in the face of Liberation Day and the tariff announcements, then went on to subsequently make new nominal all-time highs. Is some caution warranted here when it comes to the gold market? Do you think we're still in the early stages of a bull cycle for gold, somewhere in between? Chris, I'll start with you on this one.
Sure. I think we are actually getting close to a more significant pullback in gold. So I would say we started a super cycle in gold in 2019. It came out of the base that had been flatlining for a while. I think we are in a super cycle to the upside, and I see gold going to 5,100 and beyond longer term down the road. I mean, many years from now, a couple of years from now. But short term wise, look at the charts. There's some really interesting price action going on. When we look at the S&P 500 weekly chart, which is this candlestick chart here, excuse me, and then we have got the gold chart, which is the yellow line. This is the 2006, 2008, and 2008 market crash. And what's really interesting here is if you notice, the stock market had its first big sell-off, and gold did the opposite. It became the most favored asset right here. Everybody wanted gold. It outperformed while the stock market sold off. And then we went into this dead cat bounce, which I believe is something we're starting right now. And gold is going to probably pull back and go get sucked down with this bear market in equities. And I think gold could pull back to maybe 2,400 or so over the next 6-8 months. So once we get into panic selling in the stock market, it pretty much pulls everything down with it. But then gold will probably bottom first and really take off. And so just knowing that the equities market sold off first and gold took off as that defensive play. This is something we see over and over again in cycles. If we take a look at this cycle chart of the stock market, as the stock market puts in a top, precious metals, more specifically gold, will outperform and shoot higher. And that's exactly what we're seeing. And if we fast forward to today, looking at the stock market in gold, we've got the stock market with the first big crack to the downside. Gold has been screaming higher as everybody wants gold. If I could overlay the dollar on here, the dollar has been going down and has put in what looks to be a massive bottom. And I find it really interesting because when I talk about gold putting in a top recently and the dollar putting in a bottom, all I get is a ton of pushback. Everybody's like, no, gold is going to the moon. And everybody says the dollar is dead. It's crashing. And when you get instant strong pushback, usually those extremes are turning points. So I think the stock market is in this dead cat bounce, and I do believe it's going to roll over. And as it rolls over, it is going to pull gold down with it for temporarily. So that's kind of where I see us in the stock market cycle, in the gold cycle going forward. And one other quick thing to quickly show here that I think is really interesting is if we pull up the chart of gold and zoom out a little bit, if we go back to look at all of these big moves from the last super cycle. So we had a super cycle start here in early 2000. Then we had the financial crisis, 2008. We had the market top. Well, we started a new super cycle here in 2019. And what's really interesting is the monthly chart shows this the best. We're in what I call like a blow off or icing on the cake type of move in the market. So if we squeeze in here, the gold has hit multiple measured levels on the chart. So we were expecting it to go to 2750 to 2800, and it hit that level. This was using Fibonacci extension. This was a target that was created back in 2003, and also a target that was created just from the lows that we saw back in 2015 to this high and to this low. This gives us those targets. And so we have two different major timeframes saying this is where gold should run to. And we've been talking about this pretty much since the breakout in 2019. What is really interesting right now is this move, this icing on the cake, this blow off phase where everybody piles in and gold squeezes higher, has happened multiple times. Each time we hit a Fibonacci target, we see these rallies. And the interesting part about these blow off moves of what happens right after we hit a Fibonacci target, and then we have this blow off move, is they're all about 22 to 24%. And then we go into a flat line or a correction or a big reset. And it happens over and over again. So multiple things on the gold chart going all the way back to 2002 signal that we've hit this level. Now we're in just like this is, if you're still long gold and you're in it for a trade, this is kind of like free money. I do expect it to pull back to 2,400 or so going forward based on this chart. And then it'll be a screaming buy. That's my take on the gold space right now.
And Jesse, your thoughts on gold and where we are in this current bull cycle?
Well, I think you picked the two wrong guests to debate. I see things exactly the same way as Chris does. I was looking at, basically using a much simpler technical framework from that 21 peak. We had a very clear corrective pattern in gold. And if you just you look at that as like a bull flag pattern, you take a measured move to the lead up to that bull flag and project, after the breakout, and you get that 2,700-ish target. And so I was very bullish until that point. I've been more conservative since then, looking for a pullback. And I think it's, gold has gotten, from a fundamental standpoint, overvalued relative to real interest rates. So you look at the change in, things like a 10-year TIPS yield. It's basically flat over the past year. That's usually a good indicator of the trend in the gold price. So it suggests gold should be pretty flat over the last, number of months, and it's been ripping higher. So it's kind of outrun some of its fundamental underpinnings. At the same time, we've seen a lot of attention, right? We've seen a lot of inflows coming into the gold ETFs and things from a sentiment standpoint. I would just point out too that one of the things that I like to look at is in terms of the fundamentals for gold and commodities in general, is just compare the gold price to other commodities. So I'll just do a little screen share here again, and this is the ratio of the gold to the oil price. And this has been a good kind of indicator over time to tell you when you want to favor oil and energy stocks over gold. And so you could see when oil got really, really cheap back in 2020, that was a great time to start selling some of your gold positions, rotate into oil. Right now, oil is, relative to gold, has only been cheaper during that 2020 crash when oil prices went negative. So oil has gotten really, really cheap relative to gold. That's usually a good buy signal. At the same time, you look at what drives the energy sector relative performance within the S&P 500, and it's two things. This was a chart I got from Jim Paulson, who does interesting macro work. And basically, when the dollar is strong, and when the dollar's weak and capacity utilization is growing, where we're potentially reindustrializing these, that's the ultimate bullish setup for energy stocks. It really drove that early 2000s to 2008-9 timeframe, that bull market in energy stocks. Since then, since 2008, 9, 10, we saw really a bottom in the dollar. Dollar's been rising really since that 2010, 11 timeframe. And we've had this weak recovery post the great financial crisis. So capacity utilization has generally been really weak. I believe we're entering in a secular bear market for the dollar and a bull market for capacity utilization, reshoring of production. All these things is going to be very good for energy demand in the years to come. So I believe from a long-term standpoint, this is shifting to where this is going to be very bullish for the energy sector relative to the rest of the market. One final chart I would just point out is what drives these longer-term trends in the dollar is just simply valuation. The dollar is extremely overvalued relative to major trading partners today. This is part of the reason why they're doing the tariffs and all these kinds of things, is I really do believe, very much like the Nixon shock back in the 1971, they want to negotiate not just better trade deals. They want to negotiate a currency component too, which would be to strengthen especially Asian currencies relative to the dollar. So these long-term valuation metrics are usually a really good indicator. You can see how much correlation there is for 10-year returns on the dollar. So the dollar should be in entering into a longer-term bear market right now, which would be generally bullish for commodities. I think right now, especially energy, is cheap relative to gold. So something I've been writing about the last couple of months is a good opportunity to kind of underweight gold within your commodities exposure and start overweighting a lot of these energy stocks.
And Chris, what is your thoughts on the energy sector at present? Do you concur? Can we finally find some divergence and debate in this interview? It should be noted that this is not a debate show. I've only had two guests actually really kind of get into it, which was Michael Pento and Steve Hanke. But then in the beginning they kind of were battling it out, taking subtle jabs at each other. But then as the interview developed, they totally were on the same page. So not a whole lot of versus action in this show. But Chris, what are your thoughts on the energy space?
Yeah. I'm a little bit bearish when it comes to energy stocks. I'm pretty bearish. I believe if we're going into a bear market, you don't want to hold any stocks, period. They all go down together. So I'm pretty bearish. We were hoping for a big pop in the XLE, like the energy sector ETF. I think it's going to be a great inverse trade. You can buy an inverse and bet on falling energy prices. Once this bounce in the stock market stalls out, starts to roll over, I think we want to bet on falling energy prices. Oil is low in value. It's broken down. To me, that was an early warning sign that the economy is slowing, that we're going to see less demand. I think oil is going to go a lot lower. I think oil is going to go down to about $45 per barrel, which is going to hurt, I think, the energy companies. It's interesting because a lot of people are looking at other stocks to get out of the energy space. They're looking at Tesla and Amazon and Apple and Nvidia, and they're like, these are killer deals for these stocks. But I think people need to realize that, the stock market in general, stocks aren't really that related to the underlying companies in terms of the stock. All it is the emotional value that people put on a company. And I remember Amazon shares were about $106 a share back in 2000, and the fundamentals and the data was so powerful that it was one of the strongest looking companies. The numbers were growing quarter after quarter. The stock price went from 106 to $6. So it felt like 94 or 95%, even though it was rock solid and it was growing by leaps and bounds. This is why I don't focus on fundamentals myself. I just follow price, is because the reality is if price is going down, we don't want to hold it or we want to take advantage of it. And it really doesn't matter what the fundamentals of a company are until we enter a new bull market. And then if you can couple fundamentals and the position of a company with, the trend moving up, then I think it's favorable. So right now I'm pretty bearish. I'm bearish on almost every asset class at this point. I think the dollar will actually have a bounce as a defensive play. It's what we've seen in the past whenever there's chaos and blood in the streets globally. And I think stocks and commodities and oil, everything will get beat up. So that's my take on it.
Well, considering how overweight my portfolio is on energy stocks, 1 point to Jesse Felder. And let's move on to the next question now. Other commodities. Jesse, you mentioned that the commodities in general, you're bullish on several different sectors in there. I'm wondering if you could maybe point to some specific commodities. Any thoughts on uranium, base metals, and anything like that?
Yeah, I'm actually wearing my Duke and Duke Commodities Brokers T-shirt. So, yeah, I'm just generally bullish on the space. I think when you look back, I'll do another screen share here, and I'll just show. There's one chart that I'm looking at in particular, and this is basically just the trend of consumer confidence is the red line in this chart. And the blue line is the stocks to commodities ratio. It's just, I think, Bloomberg Commodities Index relative to the S&P 500. You can see when consumer confidence is trending higher, you generally want to own stocks and avoid commodities. When consumer confidence trends lower, you want to avoid stocks and favor commodities. And so right now, we've seen consumer confidence plunge again recently back to the 2020 lows. In some cases, this is Conference Board consumer confidence, but University of Michigan is even worse. The fit is better with Conference Board here, so that's why I use it in this case. But it's clearly suggests that right now you want to. I believe we're in an environment, and we have been for the last few years, where you really do want to favor commodities over generally other financial assets. And, just when you look at the chart of commodities over the past few years, you can see we've been building a base. We've peaked back in, early 2022. We've sold off pretty hard over the last few years and forming a nice kind of, basing structure, I think, in the commodities. I'd want to see before I get really bullish, it break out above that horizontal resistance. But generally, I do believe we're kind of in a basing pattern. And I believe the trend of stagflation, which is going to drive consumer confidence, generally in that lower downtrend, means you want to favor commodities, real assets broadly over financial assets, which would include bonds as well as stocks.
And just a quick follow-up, and then I'll get Chris's take. How would you favor getting exposure to the commodities sector? Do you trade futures? Do you look at producing companies, ETFs, the physical commodity when you can get access to it, whether that's physical gold or silver or something like a, physical trust that holds the actual commodity? What are your thoughts there?
Yeah, I have a core position in precious metals, but as I mentioned before, I use the mining stocks to kind of flex that position from overweight to neutral. And I don't own any of the mining stocks today because I am more neutral on gold. I do believe we're in a corrective phase that could last a year, another maybe even a year and a half, something like it. That's kind of what gold does. Goes through these prolonged sideways corrections, which kind of convince everybody the bull market's over and they forget about it, and then it's a good time to buy it again. I use the insider activity to kind of gauge my individual stock selection, and we have had some interesting insider buying in the energy space. So there's been a number of names. Actually, it was interesting to see the Berkshire Hathaway shareholder meeting. Buffett celebrated in his retirement, and he's obviously the greatest investor of multi generations. But it was interesting to see him ridiculed for his purchase of Occidental Petroleum over the last couple of years. I believe that's a stock that's probably too cheap. Has had insider buying in addition to Buffett's buying, but he's not the only billionaire who's been buying energy stocks, right? Insider activity is generally very bearish on the stock market, but we've seen a number of billionaires investors loading up on energy stocks over the last 12 months. Another one I would point out is Jerry Jones, owner of the Dallas Cowboys, was buying Comstock Resources pretty heavily last year. That's had a really nice run to the upside. But Carl Icahn has been buying energy stocks. Carlos Slim, one of the wealthiest men in Mexico, has been buying PBF Energy, a big refiner, and one of the few refiners still operating in the state of California in the Los Angeles area. So I think there's interesting opportunities in the energy sector in particular. not only due to those macro dynamics that I'm pointing out, but also because the insider activity there is fairly bullish.
And Chris, you said you're fairly bearish on equities in general moving forward. When it comes to the commodities space, if we, first of all, your shorter term outlook, and then if we, zoom out to the long term, 3, 5 years into the future, would you still maintain that bearish outlook, or do you think eventually we are going to see commodities potentially outperform the broad market?
Yeah, I think Jesse's right. I think longer term, I think commodities are the place to be. You look at the valuation between like the stock valuation and commodities. Commodities are like so undervalued compared to equities. It's way out of whack. But to me, the catch is when we enter a recession or a bear market, which I believe are in or entering, almost all it doesn't matter. Go look at all the global indices. Go look at all the commodities. When we enter a recession, everything pretty much goes down, even if it is maybe doesn't go down as much. So I'm not a fan of holding any commodities through this type of reset that I believe we're going through. So that's kind of where I stand. Long term, I think commodities are going to be, very good. Short term wise, as you just mentioned, this is the chart of gold, the daily chart of gold, and we actually trimmed out and closed our position in gold a couple of days ago. We trimmed off some profits, closed the rest out today. So short term wise, we're kind of out of gold. In terms of some other interesting plays here, uranium stocks. Now, uranium stocks, we also locked in gains. We closed out some of this position already. I think uranium is going to be a really good energy play. And I don't know this space that well. All I know is long term, I really like the play of uranium. When we look at the chart, it has built a massive, massive bottom and a base. I think uranium is a commodity play. It's an energy play. It is, I think, even somewhat some of a technology play. I think it's got huge potential. I think one of the most powerful resources, pardon the pun, is going to be power, electricity. And I remember I used to work in a water bottling company when I was younger, and water was so cheap. And now, like a bottle of water costs, like a liter of water costs more than a liter of fuel, of gas. So I think energy, with everything that we're doing, is going to become one of the hottest commodities. Uranium, I think, and uranium stocks are going to be one of the sweet plays to take advantage of it. So I'm not as excited about the energy in terms of natural gas or oil. It feels to me like it's almost like old energy. I'm interested in uranium and all these many facilities coming online. Again, I do think they're all going to get a haircut. I think that if you can keep your gunpowder dry, preserve your capital, or benefit from the falling market that I think is kind of upon us here, you'll have all that money to reinvest into all kinds of these, into the energy plays and technology and commodities, and come out, much further ahead if you hold on before jumping the gun. Because to me, the sentiment and shift is to the downside for the market. So I wouldn't get involved in commodities yet, although I have my eyes on gold, silver, miners, uranium stocks. I'm big into the humanoid robot space. I really like that. I don't own anything yet, but I'm building my watch list of who I want to get in, because it is going to be one of the biggest markets, not only for human consumption or use around the house, $35,000 for a robot that can do all kinds of stuff, but it'll be, amazing for factories and plants and all that stuff. So the key is protecting and keeping your value, your wealth, while we go through a reset, and then being able to redeploy, because everything will be a steal if you can hold off long enough. That's the way I see it.
Well, that leads perfectly into the final question I want to ask both of you, which is a thought experiment. If I was to, let's say you lost all of your assets, all your stocks, bonds, everything like that was wiped out, and I gave you, let's say, 100K, where would you be looking in today's market to deploy that capital? Cash or treasury bills is also a valid option if you think now is just a better time to sit on the sidelines. Jesse, what do you think?
Yeah, I'm glad you mentioned that, because I do have, one account that's literally just in T-bills right now. It's not invested at all. And I do think Chris makes a great point about capital preservation, and there's an optionality there with cash. I mean, making 4% in T-bills right now, it's hard to to beat compared to when you think about the last 15 years and 0% interest rates. And, owning cash was a lot more difficult decision than it was today. And I would just point out, we haven't really talked about bonds. I don't really, this is, Buffett, I think, JP Morgan, I think, pointed out Buffett now owns, I think, 5% in the entire T-bill market, which, 350 billion of cash. In the past, during this point in the cycle, when Buffett saw fit to build up cash and await better opportunities, I remember in the late 1990s, he was buying a bunch of zero coupon treasury bonds, betting essentially it's essentially the best way you can bet on lower interest rates. And that turned out to be a great trade when, Greenspan had to lower rates to 1%, and those long-term bonds did fabulously well. I think it's worth pointing out today he owns no bonds. It's all in T-bills. And at the last meeting, he pointed out, he specifically talked about potential for runaway interest rates and exponentially growing debt. That's as close to Buffett saying that he's worried about a debt crisis as he will ever get. So I think there's reasons to avoid bonds right now. I think with inflation potentially basing at 3.5%, I'm talking about median CPI, potentially basing at 3.5% and heading higher. I think I don't want to own any bonds. I think that even from a technical standpoint too, it looks like we've kind of been in very much like gold was for that 2-year sideways corrective period. That's kind of what it looks like we're doing in the 10-year yield right now, and we could be testing the highs sometime over the next few months. So I want to avoid bonds. I want to own. There's not a lot, I think, in the stock market other than the energy sector that looks compelling to me. I think the risk is much greater than potential reward. And there's really, a lot to like about just owning T-bills right now.
Great thoughts, Chris.
Yeah, I've got another pretty boring answer, boring investment, which is like we're heavy in cash. Our long-term investment portfolio is strictly in cash, just earning interest, and we're holding it in the I'm Canadian based, so I'm holding in U.S. dollars because I believe the dollar is about to have a bounce. The Canadian dollar exchange, I think, is going to be favorable for our currency play. And we more or less are just waiting to see what's going to happen with this market short term. How long do we have to hold this position that you're putting on? If we have to hold it for like a year, it really, I think, is just going to be cash, and probably in the U.S. currency. And that's about it. I mean, interest rates, they don't look good when I draw the charts on the yields. I mean, it's showing the yields potentially having a huge rally, which nobody even wants to know those values. And of course, it's going to cripple potentially the U.S. It's going to kill the bond pricing. So you really don't want to take advantage or try to take advantage of bonds. Everybody seems to be picking a bottom in bonds, thinking it's putting in the stage one base, but it's still making a series of lower highs, lower lows. And if rates go up and inflation kicks around for a while, I mean, bonds are going to be dead money. It's going to be a real waste with a lot of downside risk. I think bonds could fall another 10, 15% from where they are. So holding them is a scary play.
Well, gentlemen, this has been a fantastic conversation packed with insights. Before I do let you go, Jesse, tell us about the Felder Report and where people can find that.
That's just thefelderreport.com. I've been publishing a premium newsletter there for the last 10 years. I started blogging back in 2005 at the peak of the housing bubble. Kind of just needed an outlet for, to write about the media at the time, and it evolved into a research product. I put up a weekly newsletter there that's free to sign up for. It's basically just the 5 links or charts that I found during the week that I found most valuable, and that's usually around some sort of a theme. Last week it was Buffett and kind of what he's been, the cash position and the energy play that I think it's fascinating that Buffett is actually doing the be greedy when others are fearful in the energy sector, and he's kind of being ridiculed for that, which confirms to me that's a clear sentiment signal in that space. But yeah, it's just thefelderreport.com.
Great. I'll put a link to that in the description below. Chris, tell us about the Technical Traders and where people can find that.
Sure. Yeah. Well, you can go to the technicaltraders.com, and my whole mission is about avoiding bear markets, protecting your capital, and preserving your lifestyle. And I run as I think something similar to Jesse. I run a financial newsletter, more or less this whole strategy. I share what I do with my portfolio. I share all my insights, including real estate and other things, precious metals. And whatever I do, I share those trades exactly with subscribers. So you really just ride my coattails. And again, you can join a free newsletter here. Get my daily and weekly insights of the markets. And, I just do ETF trades. I focus on catching waves that roll through various assets every year. There's about 5 to 12 waves that roll through, and we just play assets and take advantage of them. And our whole focus is preserving capital, number one, and then making sure we preserve our lifestyle and have gunpowder dry for new market opportunities as they appear.
Great. Well, there'll be a link in the description below to the technicaltraders.com as well for people who want to check it out. Gentlemen, it's been a blast. Thank you so much for coming on the show.
That was a lot of fun,
Thanks.
Jesse. Thanks for having me.
Yeah, thanks, Jesse. Take care.